Okay, well, as I've said, welcome everyone. Today we're having the one of the 2 weeks that we have left for January, and we will speak about fundraising. And why not to speak about fundraising with our own partner fund? Let's put it like that, Constructor Capital. And today we have three speakers, not just one. We have Marie, we have Matthias, and we have Aram, who will share their vision, their point of view, and some tips and tricks on fundraising for you guys. So without further ado, I am giving the floor to you guys. I don't know who will start. Matthias,
Yeah, I
Marie.
can start. Yeah, I can start.
Okay.
Fantastic. Well, okay. Good to have you and welcome back from the holidays. We're obviously a sponsor of Constructor Start, so very happy sponsor. We're actually doing this now for the third time. And just today, actually, we got feedback from one of the companies that was a winner in one of the competition, and they're really taking off. Dimitri, I forwarded it to you. It seems like we're really after something with Constructor Start, and some companies are going into very high valuation territory. But anyhow, today we wanted to talk about funding. So I have two colleagues of mine, so Marie and Aram. I let them introduce themselves in a second. I'm Matthias. I'm the managing partner of Constructor Capital. I'm based in Zurich. Constructor Capital is an early stage VC fund. Maybe you've seen something about us. We just closed Fund One at around 115 million US dollar that we collected. Started about 2.5 years ago with the fundraising. We invested so far around 40 million or so into about 20 companies. And this is a combination of early stage start type of companies, but also more mature companies. Obviously, the bigger driver of the value of the fund is the mature companies. We invest in three areas. One is deep tech, future compute, next generation computing, photonics, these kind of topics. Also, AI infrastructure. And we're looking at some energy topics, etc. Second one is then SaaS, mainly B2B SaaS. We're not doing B2C and we're not doing fintech, but B2B SaaS. And the third one is education tech. So these are the three areas that we're investing in. As I said, I'm the managing partner. Marie is a partner. Let her introduce herself. And then Aram is a senior associate in our fund. We'll talk a bit about how funds think about fundraising. Not fundraising, but how you should think about how funds think about if you're doing fundraising that way around. Marie.
Yes, Matthias, many thanks for your introduction. Hi, guys. My name is Maria Lepsky, and I'm general partner at Constructor Capital, more focusing on our deep tech portfolio related to quantum tech, advanced materials, optics, photonics, and whatever else is appearing in this market. I'm based in Cyprus and have several companies in our current Constructor Start batch, which I'm mentoring. Aram.
Yeah, my name is Aram, and I'm a VC associate. We are responsible actually for whole value chain of any deals, like from searching, finding the deals, making due diligence, and even executing the the deals in terms of negotiating the term sheet and so on. And yeah, happy to discuss how can you make your fundraising process much simpler and better.
Well, good. We've got a few pages. Maybe, Aram, you want to pull them up? Ideas
Yeah, I'll share the screen.
make it interactive, send us messages, interrupt if you want. I mean, it's not a big group. I see something like 20 people. So if you have questions, just get going and ask us. Yeah, you see a bit our background. So I used to work with McKinsey. Marie was with Luna Capital and was with Sevastal Ventures and Ozon. Let's go to the next page. So first of all, today we're talking about how a VC fund works. It's very different from business angels. I mean, it can well be that once you get your company going, your first investors will be business angels. Typically, it's people in your network, it's people from the industry that in which you're creating your company. In a certain way, They are probably less structured, less systematic in doing investments. It's more relationship driven. It's more theme driven. It's more, if they're excited about, the field that you're in or the company. So you can derive, some learnings also for business angels, but we will present it from a fund perspective, which is obviously much more professional in terms of investing. How does a fund work, right? How does, for example, Constructor Capital work? So the first job that a fund does is to collect money that they can invest. And typically the way it works is, you have a bunch of people who, get together and say, we want to create a fund. This is our investment hypothesis. This is the theme. This is the kind of companies we want to invest in. And they put in their own money. Typically, it's typically up to 20% of the fund. So your 100 million fund, you would need to have, some business experienced people who have a background, created own companies, managers, partners in top tier consulting firms, investment bankers, etc. They say we become a general partner, put some money in, and then you go to another set of partners, which are called limited partners, LPs, and you collect money from them. Okay, and basically you go there. You tell them, look, we know a lot about, in our case, deep tech, quantum computing, next generation compute, network. We created a lot of software companies. Obviously, Serge is a GP, and you can obviously show all the stories, what he did in Acronis and Aquamatica and many, many others. And you tell limited partners, you can invest in us and it will provide good return. Okay, so you collect monies and you do that over time. It doesn't happen in one event. I mean, you do several closings, you do it over a period of time. Okay, and then, the fund has money, doesn't collect all the money at the same time. So, for example, if we say we have 100 million, we don't call immediately the entire 100 million. We take, first 20%, let's say, and then we invest them. And then once we have spent that money, we call the next percentage, etc. So you collect the money over time, and then you put it in various investments. Okay. So what is the objective? I mean, first of all, the objective of this fund is to generate returns for limited partners. Okay. And for these limited partners, obviously the fund has a lot of disadvantages. It's illiquid. So you bound your money for something like 10 years. Second, you don't control because all decisions are taken by the general partner. So you have no control. Typically, it's a black box. You trust the general partner, you give them money, and you hope that they will return something. And thirdly, you pay fees. Okay, so you pay 2% management fees on the fund every single year. And you pay also what is called carry, which is basically participation on the upside. Typically, it's 20% of the upside. Okay, so it starts with a lot of disadvantages. Not in control, money is bound for a long time, and you have to pay management fees and carry. So you need to have a trust as a limited partner that these guys who are the GP, that they will outperform the market significantly. Significantly. It's a very important word here. If you're just trailing the market, if you're going, with returns similar to Nasdaq or something, it's a bad investment for you as an LP because for all the disadvantages I just described. So therefore, number one, it's typically investors who have already made quite some money. It's typically not their first investment. I mean, they start with different investments, real estate, stocks, etc., etc. And they need to have a lot of trust in you as a manager to provide good returns. Okay, and they need to commit to 8 to 10 years. So that's how it works roughly. Okay, and after 10 years, typically the fund needs to return the money. If you want to do good returns, so typically there's something like a hurdle rate that you need to deliver as a fund. Before that, you don't get any upside. If you want to deliver the good returns, you probably need to make out of 100 million at least 300 million over these 10 years, right? Because with all the interest, all the fees, etc., you need to triple the capital that you invested. Okay, so that's how it works. And then there's a lot of technical stuff where you put the fund, in which geography, cetera, et cetera. But in principle, you need to take into account that the fund manager needs to find investment opportunities with real high upside, because otherwise the economics with all the cost and illiquidity won't work. Yeah. Next page. That's what this page also shows, right? So the name of the game for us as a venture capital fund is to find investments where we make 5x, 10x type of returns. Okay, that's the only thing that really matters. So we need to, we're not looking for investments where we get our money back ×2 or something. In reality, if you take the 10-year horizon, that's a loss. It's not going to deliver the hurdle rate. It's obviously better than losing completely the money. But the name of the game of the venture capital fund is to get outsized returns, which obviously comes also with higher risks. Okay, that's what we're looking for. So if we take an investment decision, we need to believe that we can make a 10x on this company. If we believe, yeah, well, we'll make some good returns, but after 5 years, it's maybe double the current value. It will not work. Okay, and the way typically the math of these funds works is that you have 1 or 2 company in the portfolio, 1 or 2 or maybe 3 companies that return the entire fund. Okay, because obviously we make mistakes. Not every company that we invest in will deliver the 10x, but you might find the 1 or 2 which deliver 20x, 30x, 50x. And if this was a big investment, then it returns the entire fund. So I've seen that. I've been on a board of a few VC funds before. It's a typical pattern. 1 or 2 investments return the fund. And obviously, you need to find them. You need to hope that the long tail of this trading here, you don't have too many and that you have not too many losses. So to minimize the downside. But what you're looking for when you take a decision is a 10x type of return, so outsized return, even if there's a certain risk involved. Okay, that's the profile. Next page. Now, how do you get to these outsized returns? So typically, when we check for investments, if companies send us a pitch deck, want to have a calls, etc., we first of all want to understand, is there a big enough market? Because you can make money in niche investments, but the 10x, the 20x returns, etc., it needs to be a big enough market. If it's a small market, there's often a lot of competition. It's painful. You can't really grow that much, etc. So the significant results are typically in big markets, and it could be future markets, right? I mean, quantum computing, it's not yet a big market, but it can be a very big market. So the returns can be outsized. If quantum computer gets the error correction right, etc., it can be a very big market. So it doesn't need to be a current big market, but it must have the potential to become a future big market. Okay. Second, we look at the team, right? And we say here, experienced teams. Experienced teams have many notions. Can be people that worked already in the industry. It can be people who studied in that field. Can also, in our deep tech investments, it's typically researchers as well. So it's people who did research in that field, etc. I mean, business angel might look different at it, but we would not invest in a team that has no experience whatsoever in that market. There are exceptions. When Zuckerberg started Facebook, he probably did not have any experience in social media, but he was a computer geek at least, and it's a bit of an exception, but typically we look for experience. And then thirdly, we're looking for a product that is sticky, that doesn't have a lot of churn, because that kills typically the economics. And the second thing, especially if you're a VC fund, you look for products which have very high cross margins. Okay, so investment in traditional industries, let's say in traditional engineering or something, where it's an established industry, there's a cross margin of 20, 30, 40% is not attractive, because if you scale, you need more and more capital. Chances that you have this outsized returns are relatively low. Okay, so it needs to be a sticky product. Ideally, in software, it's a SaaS with automatic renewal. In deep tech, it is a product that starts with the first version and then can grow in terms of functionality, etc. It needs to be sticky, and it needs to have a high gross margin. Low gross margin or consumer goods is low gross margin. We would not invest in consumer goods. Can be great business. They're big companies like Nestle, very successful companies, but it's not for VCs. Okay, so that's the first criteria. Move to the next page.
Yeah, actually, it's my part.
Okay, go.
And yeah, I want to maybe emphasize why actually the big market is so important, because like intuitively maybe it's not so clear. But let's start maybe from the key parameter which venture capitals try to maximize, and it's return. Yes, I mean like how much money do you receive versus like how much money did you invest. And in reality, the return is like directly linked to like other parameter, which also quite important, is like valuation. And again, like if you invested in company at 10 million and now you exited in at like valuation in 200 or even like 1 billion, it's a great story, yeah. And but why companies typically yes valued a lot. I mean, like in 200 or maybe 300 or maybe 1 billion, yes, US dollars, because they generate like significant revenue. And revenue, it reflects the scale and maturity of the company. And for most like venture capital, the mental benchmark when the company is super ready to be like exited or maybe like even IPO'd is like 100 million IRR, is a sign of large and even like successful business. And now we are coming like maybe the key point, yes, why the market is so important. If we should generate like 100 million IRR, yes, it's a total different story if we are working in different markets. If you are working in super huge market like 10 billion or maybe 100 billion, to like reach this goal like 100 million IRR, we should reach only like I don't know 1% or even less share, which actually looks like doable. If you're working like in a big market, to reach 1% of this market or even less is like it doesn't look like super hard task. You should be only like top 8 or maybe top 10 player to reach this goal. But if your market is super small, yes, it means you should to reach to this goal, like you can like some benchmark in 100 million IRR, you should be like a total monopolist, and you should reach 100% of this market, which is like much harder task. Again, like to be in like player number 8 is much easier in big market than to be number 1 is smaller market. That's why we want to see like players who playing in big markets, because to reach to these like high valuations, it will be much easier. And actually on the right side is some typical some toy model which presents actually this like example which I described before. And next slide, yes, this is a example of one of our investments which we done like 2 years ago. It's a Lumai, and actually Lumai totally like satisfy of this criteria, because again they have a great team, their product is quite good, I mean like in terms of technical performance, but the key point, they are working in quite massive and growing market. Yes, what actually Lumai does, they are building optical AI accelerator, like NVIDIA doing actually with their GPUs, but these guys working in optical domain. And the GPUs is a super huge market. We can look to NVIDIA financials and see that their revenue growing like crazy. And in previous years, they generated more than 100 billion selling their GPUs to data centers. It means the market even bigger. Yes, and it will be even bigger because now we have all these CapEx plans of biggest players like Google, Meta, Amazon, who will buy more and more of these type of devices. And Lumai working in this domain, even if they will be like player number, I don't know, like 15 or maybe like 16, and they will gain only less than 1% of this market, they will generate significant revenue. That's why like market is super important. That's why actually we allocated more than 3 million to this company 2 years ago, and they are doing pretty well, and they are planning to raise even more to like go further and further.
Yes, this is my part. So for sure, very important is the team and founders behind. And when we're analyzing the team, we are looking at your experience in both technology and business side. So, for example, you can have a previous tech experience. You can be spending like 8, 10, 15 years at some scaling company, building the tech infrastructure, for example, from scratch, or leading quite significant team of engineers and product leaders. For sure, we're looking at your previous business experience. For example, you could founded other startups or could play management role and served as CEO or CEO or chief product officer or CTO, even if you failed. So for us, it means that you have experience, and for sure it depends on which area your startup was. It would be also valuable for us. But because we invest in also in deep tech founders, in deep tech startups, we are looking at academical and technical credentials. And we have, for example, in Lumai, which Aram mentioned, and in several more deep tech companies, we have quite young management teams, which were recently, PhDs or postdocs. And they could be, less than 30 years old. For sure, they don't have a significant business experience or even technical experience, but they have great or good research criteria, as, for example, patents, as, for example, publications, citations for their research that they made in postdoc or PhDs or in the current company. So we are looking at all three criteria in our case when we are analyzing team and founders. And as you can see in this diagram, the sweet spot of ages for us is between 30 till 50 years old, so when we can see the biggest number of high growth startups and unicorns. For sure, there are exceptions, but this is sweet spot. Next slide, please. Yes,
So
and this is
a quick
example.
question to the previous slides. If you look at the bar chart, it seems like the unicorn founders are mostly younger than 30, or do I not understand something about this?
No, this is like in total, we are calculating both unicorns and high growth startups, not only unicorns.
Okay, but from this graph, what you say is that 30 to 50 is like the sweet spot, but on this graph, it looks more like younger than 30 would be the sweet spot, because there you have 35%.
You have probably more outliers on the on the young ones. Yeah, it's both. By the way, it is not sweat spot, it's sweet spot. We need to.
Yeah.
Aram.
Yeah. Sorry.
Okay.
Yeah.
Look, I mean, in software, etc. I mean, we're maybe a bit biased. Just a small comment. In software, or in consumer tech, many of the unicorn founders are younger. That's true, right? Because they come out of youth, they come with the biggest, new ideas. They really feel, what the youth wants, and obviously everybody follows the youth in these kind of consumer tech companies. We're biased more towards, deep tech,
Deep tech, yes.
scientific-based innovation, and they are, low 30, you don't have a PhD typically, you don't have the research experience, etc. So nobody will build a next generation computer, photonic computer, for example, the one that Ara mentioned, with 25 years. Right? It's just not possible. Okay.
Thank you, Matthias. Yes, so this is examples of our portfolio companies, founders, and most of founders of our B2B platform SaaS startups have quite exceptional business experience, including successful exits. Yes, this is different story from, as Matthias mentioned, deep tech founders, but still very important for us because we're also investing in software startups. So, for example, we have portfolio company called Basemark, and Basemark develops software solutions for automotive applications. The founder and CEO of the company, Tara, previously founded several companies, including one company, Rightware, which was acquired, and he also served as the CEO of mid-sized company previously. So he has significant hands-on experience in creating and managing companies, which is very important for us. And for example, Decor, the company already in series now B, we invested it like a year and a half ago, and they're producing AI infrastructure solution for enterprises and for data centers. The company was founded by founders of Wargaming, Nick Katsalapov and Andrea Reitenbach. And they both were not only founders of Wargaming, but also they were in management team for many, many years, like more than 10 and 15 years. Wargaming is one of the leading and most successful companies in Central and Eastern Europe region, with the revenue of more than $500 million. Awesome is accounting services and assistance for small and medium enterprises. The company was founded by Viktor Lysenko, whom we know when we invested in Awesome for quite a while, more than 10 years. Viktor was also founder of Rocket Bank. Rocket Bank is like 1 decade ago, it was one of the leading neobanks, also in Central Europe and Eastern Europe region. So Viktor also had quite significant, founder and also management experience. New AI is a company founded by David Yan. David founded also 10 more companies before, with 2 large players like Ebby and also ICO. So this, these companies has also a lot of clients, more than 50,000 connected restaurants and cafes, particularly ICO, and this helped to his current business, New AI, which is doing platform for creating AI employees. It helps with client base as well. So this is not only about founder experience and management experience, but also, this is about bringing client base and partners base. Next slide, please. Yes, but as we mentioned already, we have also our deep tech portfolio, where we have younger founders with less, business experience, but with quite significant track record in their scientific path. Lumai, which we already mentioned several times, it was founded by Janjin and James. Both of them were PhD and postdocs in one of Oxford quantum laboratories, founded by Alex Lvovsky. So they both have quite significant, citation and publications and patent track record. Konami is quantum sensing company out of Basel. founded by Matthew, Alexander, and also Patrick, who is not in this list, but also important co-founder. And for example, Patrick was, before he founded Konami, he was in Harvard Quantum Laboratory of Michelin for many, many years. And Matthew, he has a PhD in quantum mechanics in University of Grenoble. So they also have quite significant scientific experience and benchmarks. Architonics are also young founders, Michael and Leonardo. Michael is PhD in computer vision and machine learning, and Leonardo worked previously, he's also PhD in applied photonics, but he worked previously in Max Planck Institute, so also has, they both have a significant track record in science. Next slide, please. Okay, so when we are looking, going to another point, we are looking at metrics and unit economics. And for sure, there are different stages even in early stage startups. So if they're talking about pre-seed stage, when we don't have, you don't have enough, IRR, enough finance traction, and maybe you have several pilots, or maybe you have, I don't know, one pilot or one customer, and you have like thousands, hundreds of dollars, like 1,000 hundreds of dollars or 2,000 of IRR. So this is very small number, which we can't estimate and prove for ourselves why we should invest in you. But in this case, they are looking quite deeply in your vision and how you see go-to-market, how you see your traction for next 1-2 years. Actually, for the period when we are investing, or even beyond it. So here, 80% of our focus is going to the vision part and 20% to numbers. But when we're talking about a more major seed stage, and it could be like a late seed or sometimes even early seed, depends on. In this case, you can have like 1, 2, in good case, $3 million IRR. And here we are looking 50-50 on both metrics, unit economics, and in your vision and numbers. Next slide, please. This is a short executive summary. Maybe this is more relevant, for late seed, Series A stages, but also quite important. So when we are looking at unit economics and metrics, we are looking at IRR, growth and retention. We are looking at go-to-market execution and performance, in gross magic numbers, in net magic numbers, in expenses and profitability, in CAC and operational expenses, in Rule of 40, in financial and valuation metrics, in EBITDA margin. It's more relevant for your, next stages of your business development, but it is what we would look at your next stages of fundraising, and also quite important metrics. For those who are already in Series Seed, some of these metrics are applicable. So please maybe save this slide for your next fundraising stages, and quite important metrics for us, but for later stage. Next slide, please. Yes.
Okay. Now, good. You got a bit the criteria that we look at. How does a VC fund decide? I mean, so we basically find some investments, the associates then collect information. We do a lot of expert calls to understand. We do many sessions. We will see you in person. We will see the entire team, etc. So that is the process, and that process can take long. I mean, as a business angel, I used to be business angel. You take a decision like that, but as a fund, we need anything between 1 month up to 1 year. Some investments we follow the company for 1 year before we take a decision, so it's relatively slow. But the way these decisions are taken is basically, so you have IC calls, investment committee calls. And in these calls, the associate, for example, in our case, Aram or senior associate Aram, would prepare a case and say, look, we want to invest in company XYZ. Typically, there's one sponsor, one partner who is a sponsor. So, for example, Marie and Aram would work together. Marie is the sponsor. The two of them present the case. And then the investment committee will take a vote and will say, yes, we will do this investment or we don't. And we discuss also, what are the exact terms of this investment and what do we ask for, et cetera, et cetera. So even though I have, for example, the title managing partner, I could not decide on my own on any investment. Okay, I'm not capable. I can promote an investment. I can say, look, I think this is a good idea. Or Marie could do that, but none of us can take a decision on their own. We need to come together. And in most committees, actually, it is anonymous vote. So all the partners need to say, yes, 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 we should do it. And then, you take a decision and then, the paperwork starts, okay? So, and, the way this is done, I mean, the IC is typically like a 1-hour call, etc. Typically, the associate prepares a memo, right, where he summarizes all the things that he learned over the course of the due diligence. So need to go into the memo, goes to the IC, go, no go. And important thing, you need to convince all partners, okay? One will take the lead. You probably have most interactions with the one that is in the lead. But at the end, typically all partners need to say yes, okay? Another point I think that's important, you sometimes get a no, but a no doesn't mean that's a no forever, right? I mean, at the end of the day, you might, take a no because, company is not ready enough, not everybody's convinced, we want to see more traction. But the fund has already spent time on your company. So it's always worthwhile to come back to them after a year or whatever when you reach the next milestone and ask them again, are you interested? Probably at a higher valuation. And you might get a yes next time. So this is not very untypical, and people learn, companies evolve, etc., etc. Now, what are reasons for no? I mean, you will probably get more no's than yeses if you go to a VC fund. That's just how life is, by the way. It's the same for me. If I do fundraising, I also get more no's than yeses. So it's just how life is in many things. Why you get no? I mean, typically the fund would give you some objective reasons why they think they wouldn't do it. Market size might be one, or financials are not attractive enough, or your valuation expectation are too high, or we feel that the team is missing technical expertise or business expertise or whatever. So we're not convinced that the technology is so distinctive, etc. That we say no. These are, you get the feedback, and you obviously have the right to ask feedback and say, these are the objective things. But you need to watch, I think the point of this chart is also, you need to watch also subjective feedback. So need to remember that all partners take jointly a decision. So if you do the pitch and you understand how the fund works, don't work only with one partner. Try to connect with all partners. Try to convince them. Don't trust that they will do that, because they all have many files, many different opportunities. So you should try to in our fund talk to maybe Marie takes the lead, but you should ask, can I talk to Matthias? Can I talk to Alex? Eventually, can I talk to Serge, etc. So make sure you cover the entire decision maker community. The second thing you need to, and that's a bit for your time management, you need to understand when you pitch to a fund, I mean, your time is scarce, and this pitching and DD takes time. So choose wisely which funds you pitch to and which ones you engage with. There might be funds that a priori are not interested or only curious, or some of them might not even have the money, but they say they have, etc. So be a bit smart upfront, so you don't get a stupid no, because in reality you spent so much time with a fund who actually doesn't have own money to invest. And then third, obviously look for the right sized fund. I mean, if you come to us and want to get a 50 million investment, we're not the right fund. We raised 120 million. We will not invest in any company 50 million. So don't even spend your time on us. Maybe we can be part of a consortium, but don't try to raise 50 million from us. But also don't come to us if you need 200,000. We will 500,000. We will not have the time to look at a 500,000 opportunity. So it's the wrong metrics. It's the wrong target that you're pitching to. So be smart where you want to invest. And it obviously is also the first investment, but also over time, for follow-ups, etc. So second point, the subjective one is be smart where you pitch, right? Because your time is scarce and you can lose a lot of time pitching to the wrong people. Okay. Let's move on. Aram, you want to wrap it up?
Yeah, and also one point which maybe like a lot of early startups don't understand. Typically, venture funds has a lot of like opportunities on their table, and sometimes they don't have enough time to consider each opportunity like super detail. That's why super important to have quite well-structured like data room or well-structured materials, which will help the person who will analyze like your company and come to like the decision. I mean, like it will be great if you will spend I don't know, like maybe 100 hours or maybe less, maybe more, to create really good and structured data room when like everything will be collected in a proper way, like pitch deck, like some kind of financials, some technical analysis, and so on. And when all these materials structured pretty well, for person who will analyze it, it will be super easier to present it to partners, to investment committee, and so on. And it will be, again, it will be and even it will be like faster. And that's why I really like want to emphasize, please don't try to like build some presentation and send it like to investors. Try to like make some draft, ask some friends to comment. They will comment. You will receive a lot of feedback, and try to do your materials is much better than possible. Yeah, and also one important point. Don't rush actually with funding and investment. Why is so important actually? In reality, the key parameter which you as a founder you want to maximize is evaluation. But to receive high evaluation from like venture capitalists, you should have quite like some facts, some results, yes, on a table. This is like illustrative example, yes, like case number 1 and case number 2. Let's start with case number 1. You have already some kind of team. Yes, you have some founders, couple like part-time employees who write in some kind of code. You have you still don't have a quite strong MVP, but you have some interest from companies. Some, I don't know, signed even a letter of intent, and no metrics at start, like revenue is 0. If you come to any venture capital fund and ask them, guys, I need, I don't know, like 500K or maybe like 1 million, believe me, you will not receive a quite high valuation, because again, at this point, you still don't have a lot at this point. It means, again, if venture capital fund will find that in your current state, your company is valued at 2 million, and you will raise like 500 million, it will result in 25% of your company you will give to fund, which actually okay, but in reality, my understanding, it's a quite high share of piece which you give to fund. But in other case, yes, in case number 2, the situation is roughly similar in reality, because yes, the same team, couple signed and paying agreements, super simple working prototype with basic functionality, I mean like MVP, and even super small revenue, like 20K IRR is nothing, to be honest. It's like 2K per month. But case number 2, it looks like much stronger than case number 1. And when you come to like funds, the probability that you will raise money at higher valuation, it will be again higher, because you have more metrics which you can play than case number 1. And but the final result is more important. In reality, you will give to the fund only, I don't know, like 20% of your company, not 25. And why it's so important, I'll tell you a bit later, because the key point is dilution. But anyway, like my idea, don't be like, again, you should make some homework before go to funds, and because again, funds wants to see some metrics, some numerics, some working prototypes, and so on. When you come without any prototype, it's so difficult to evaluate what you are doing. And in reality now, when we have a lot of AI tools, and you're working like in software, yes, to build MVP, it's super simple. You like, again, like 5 years ago, maybe it wasn't super simple, because you should have like programists, I don't know, 5 team in 5 or 6 people. But now when you have like Cursor or like other tools, you can build really working prototype. Again, when you really understand what do you want to see as an outcome, yeah, you can build a really working prototype, again, like maybe in 1 month, by using super like primitive and generic tools like Cursor and others. And even you can you will spend I don't know, like maybe 1 or 2,000 USD, not like tens or like or hundreds thousand USD. It means you really can do it on your own. But in reality, you will have really working product and even some revenue, which will help you to have quite high valuation. And actually, why it's so important? Yeah, this is so interesting graph, which demonstrate there are a lot of famous companies presented here, and in reality is presenting what is a ownership of the founders when the company exited, like IPO'd or maybe acquired by big companies. And as you see, in reality, the numerics is not so really high. I mean, if you build a company, in average, you will have only 22% of your founding companies. I mean, like in terms of ownership, like 80% will be distributed to investors. But the key point here, if you will start again from super aggressive inverse term valuations, like in case number 1, in reality, maybe in the end of your story, of your company story, yes, you will have maybe 5% of ownership, like 10% of ownership, which will give you not really high return. Yes, this is a point which I want to deliver. That's why you should think about like your valuation and the results from like 0, not going to rush and starting to raise the money. This is like also quite an important point which I want to deliver. Besides the point, and you should have quite really good and structured data room. And yeah, that's all actually. This is like summary.
Yeah, I mean, I think we said it all. Yeah, funding is important. Obviously, this is why you're doing Constructor Start. you understand a bit, criteria, how we look at it, market, team, product, etc. Be aware that you need to convince the entire investment committee, not only one associate and one partner. Be aware that you don't spend your time on, funds that, will turn you down for the wrong reasons, subjective reasons rather than objective reasons. Be prepared, really think through when you want to take, external money because it's dilutive. There's a lot of things to be said about non-dilutive money, different financing options, etc. But principle, you will do several rounds, so be aware, think through, how much you want to keep, and don't rush into fundraising, and try to do it smartly with little dilution. And there was one good question in the chat, and then I open it up from Artem. It says, 60% of VC funds are actually failing. I think in a certain way that's probably true. It depends on how you define failing. But if you say, VC fund needs to deliver hurdle rate, and then on top real return to their LPs and eventually also to their GPs, I would assume that a lot of them will not even make the hurdle rate, or don't deliver returns higher than that. It's not an easy game. And as a LP investor, you should really watch out for funds who basically raise money only to live on the management fee. I mean, this is the wrong investments, right? Because then they eat every year 2% of your capital. They will never return something. So that is a bad fund, right? And you need to, as a fund, really be, as an investor, choose funds that want to deliver more. But Artem, you want to say something more?
Yes, thank you. Can you hear me?
Yeah.
All right. I have a question about evaluation. So it was a remark about evaluation being a metric, like you have 10x of your revenue or something, right? I wonder how true is that, because I've seen that, for example, INQ went on IPO with revenue of like 5 million euro, and they were valued at €1 billion, not $1 billion, sorry. So how we can leverage that metric in startup advantage?
Yeah. It really depends. I mean, also in our discussion, it really depends on the industry. Okay. If you're a traditional SaaS software company, you will probably do some bootstrapping at the beginning, and your first funding, you want it or not, will be somehow anchored on your current revenue or ARR, committed revenue, or some metric that relates to revenue. Okay, so if we invest in something that we know and understand and that isn't completely disruptive, I mean, Aram is looking now at a bunch of software companies. For example, in pricing, we're looking at pricing software companies. At the end of the day, we will say, technology must be super good, but we will not pay more than 10 times revenue. Okay. Other people might do that, but we will not do that. So in industries that are well understood, especially software, revenues matter. In deep tech, frankly, I don't care about revenues at all. Okay. Because take even these quantum companies you mentioned now, INQ, I mean, the revenues that they're showing are fake revenues. Because yes, they get money, but it's typically government investors, it's research labs, etc. It's completely fake, right? It could be also a grant. It's very subtle, the difference between grant and fund revenues. I mean, Marie, we looked at a company that had 20 million revenues, very reasonable valuation. Below 100 million, we decided not to invest. If you had compared that to INQ, they would be a 5 times unicorn. But we were not convinced by the technology. I couldn't care less about their revenues because it's government revenues, et cetera, et cetera. So in deep tech, revenues in most cases don't matter. They're good because they will provide you longer runway. But for my valuation, it's not very relevant. Whereas in software, it's super relevant.
Thank you.
Yes, Ivan. Yes, thank you so much. And yeah, Ivan, you have also a question.
Thank you. Yeah, that's it. Yeah, first of all, Marias, Aram, Marie, I really want to thank you for the such an informative and data-rich, mostly important to me, presentation. So that was really great. So my question might be
Thank you.
pretty particular, relevant for B2C first startups. And knowing like Constructor start, and maybe it's true for other venture capitals, mostly look into B2B opportunities. And following on, Maria, your point on the team experience and the vision they articulate. So I wonder, so once this bar is met in general, like for all kind of startups, what non-revenue signals maybe make you confident, let's say, in the future enterprise value of the B2C first, but still B2B oriented startups like ours in particular? So what signals do you see as the like key success in future for the enterprise value ones? Thank you.
Marie, you want to start? And then Aram.
Aram, I think maybe.
Okay, all right.
Yeah, I can start. For me, the key point will be, again, there will be 2 points if you don't have any numerics and any financials. First one is real unmet needs in the market. I mean, like interviews with potential customers, blah blah, which will shed the light and explain, help to understand actually this product really needs or not. Is number one. And second one, of course, is like potential market sizing. As I mentioned before, if you see like the market is huge, like I can give you like some example. Now we are looking at some company which built in a tool in reality like application, 100% B2C solution, helping to analyze like your game in tennis on your iPhone. You can install your set up actually your iPhone. It will record in some videos and will give you some insights and give you some hints, blah blah. And again, they key actually tech value propositions that they make all calculations actually at edge, and you don't need to. I mean, like at your iPhone, and you don't need to send whole data to data centers and make calculations on our GPUs and so on. And they make it faster. But now it like presented is a 100% B2C solution, and yeah. Now, yes, there were, and in reality, what's the key point? The market, because there are a lot of players in tennis, and not only in tennis, in like rocket, in other rocket games, like paddle and so on. And this is a like huge signal that this company can be valued, I don't know, like in hundreds of million USD and so on.
Yeah, and
I mean, like,
and they are apparently, at least the leader. They don't have huge revenues, but they are at least the leader, technically the leader in that field. So the market might evolve. So it's a future market. Yeah.
Yeah.
So what else do I look at in B2B? For example, I look at how many customers they have. Even if revenues are low, if you depend on one single customer, I mean, so many companies fucked up because they have one customer and the customer walks away and company is bust. Okay, so
can I clarify this point for a second? Which the question is pretty, I think I haven't got an answer for myself still. So do you value and look more onto the active users, like daily or monthly users, or the number of users overall that have ever tried your product?
No, of course, when you are talking, again, when you are talking about like established product, the key metrics is like active users,
always
like MAU, DAO, SHMAU, and so on. And of course, like again, we are talking about business. Yes, it should be some paying customers. Okay, maybe you can have like free customers, but you should have some kind of revenue from ads. I don't know, from anything. I mean, again, you can have in a typical social network solutions, you can have like millions of users, but again, nobody spend and you don't have a quite good business model. And again, back to your question, if you're talking about users, of course, the key parameter is a MAU DAO
Okay.
And in reality, it also like ratio MAU to like WOW, because again, you should have quite significant retention. Because again, like in day number one, you can have 100 users, but in 1 week you can have 0, because there is nothing retains them to back to your application and use it.
Yeah, that's very valuable. And I know we already discussed this with Maria, whom I'm proud to have like as one of our mentors of our startup. So I'm seeing that like pre-revenue early stage startups, they mostly show off that they have like X thousands of people on the wait list. And we are mostly focusing on having like 100, let's say, weekly or monthly active users rather than, like potential people who might be interested. So wondering whether like you share the same point.
Again, as soon as you don't have any revenue, it doesn't matter. You have like 100 users, active users, or maybe 10,000 users, because as soon as you will start to charge them, maybe your 10,000 users will be 0. But maybe for 100 users, it will be the same number. Again, it all depends. But the key point, you should, again, as I mentioned, it should be real pain for which customers should use and pay for your solution. I mean, it shouldn't be like something for second TikTok or second YouTube, because again, I can switch easily to another platform and that's all. You will lose as a customer. But if you will present something unique, which really help user, again, he will stay on your platform and even pay more and more.
For sure. Yep, thank you.
All right. Yes, thank you so much for the question. And Rusev, your turn.
Yeah, thank you. Thank you, Rina. Matthias, Mary, Aram, this has been one of the best sessions I ever been. So thank you. Very informative. So at first, for my startup, it's an AI native learning platform. I wanted, to go global, and then I participated in this program in Canada. And from the advising that I'm receiving from my mentor from Next University, he told me, hey, let's focus on LATAM because that's your big strength and you know the market and stuff. So 3 weeks ago, I pretty much changed everything and started speaking in Spanish in LinkedIn. So I have to switch a lot of stuff, but I'm worried about how I'm gonna transmit that this has a possibility of being really a global company. But not right now. My speech is, hey, the first 2 years we're gonna take Latin America by assault because we're gonna be the best in LATAM, and then we're gonna switch in the year number 3 to a global market. But I have to adjust my predictions. I have to adjust my annual revenue predictions, and the evaluations and stuff. So I don't know if I'm taking the right approach of saying, hey, I'm going for this Spanish-speaking market the first 2 years, and then I'm switching to global, since I believe we can do that. And my second question will be, I have been advised to lower what I'm seeking in terms of investment. So instead of saying, hey, I'm going for $500,000 and going to give me a 18 months runway, saying I'm going for $300,000, that is going to give me the same time of runway, and I'm going to facilitate the investment on my startup. But I really don't know if we're going for higher amount, lower amount, and if the right focus is to first start with Spanish-speaking market and then pivot to something greater. So that will be my questions.
Regarding the second question, let me jump in here. So regarding the second question, actually, our suggestion is to raise, such amount of money, which for sure you understand how you will spend and how long it will take for you, for your runway. So if you're sure how you would spend, I don't know, 300K or 500K or 1 million, because I'm not familiar with your, with your business and with your startup, difficult to judge here, but you should understand for yourself, like how long you would spend this money and what you will achieve with this money. And because, of different amounts, you can be like diluted more or diluted less, depends on the terms. And for example, if you will show, I don't know, like some kind of a product during this 1 year or 2 years of runway, you would be in better conditions to raise new capital. So actually, it depends on your vision and your realistic vision, how you will spend this money and what you will achieve here. And after that, you can understand how you would be diluted and how do you want to be diluted here, and in which terms you can agree with a potential investor.
The question will be, should I tie it up to the runway? I mean, should I be focused on, hey, let's have this X amount of money to have 18 months of runway, for instance? I have very clear my objective in terms of annual recurring revenue. So I would say like, hey, if we have the 18 months, we're gonna get 1.5 annual recurring revenue, $1 million, you know? But I don't know what's really the factor of, if it should be the runway, what should really be that factor in terms of what I'm asking for.
Yeah, I don't know. I mean, software companies, I mean, well, first of all, it doesn't sound to me very credible that you conquer the world, right? So it's much more, I mean, you need to have credibility, right? We will not invest in bullshit artists. So if you tell me you're immediately going for the world, I mean, it's typically naive, okay? So it's much better to choose a smaller market. I mean, yes, there's a big debate, should you go for a European market at all because Europe is complicated, or do you want to go for the US because it's easier? If you have an edge in Latin America or a Spanish-speaking country, you should definitely start there, because otherwise, I mean, how do I believe you that you will, create a company, and how do you go to market, etc. So that's that. Look, and again, how much money. I mean, the best thing is at the beginning to do some bootstrapping, because otherwise, no VC fund will invest you unless you have a technology startup with a distinctive technology. But with more software, nobody will invest you. Do some bootstrapping, find some triple Fs, so friends, fool, family, get some money from them, get recent some traction, because want it or not, for software, we will apply some sort of multiple. And, this can be anywhere between 5 and 20, depending on how excited we are. 5 is probably a lower bound, 20 is the upper bound. It is good for your own dilution that you don't, raise too much capital, and that you can show some revenue traction. I mean, that's generic.
Of course,
if Aram proposes to me a software company and says, Matthias, you have to pay 20 times revenue multiple, I will ask him 10 times, why do you think this company is so distinctive that I would be willing to pay a 20 times revenue multiple? Might still be, if you're an AI startup, you have a distinct, I mean, we're looking at a couple of AI companies now. For example, one that does compression algorithms for AI models. They have some revenues. We might be willing to pay 20 times revenue, but then we do it based on technology, not based on the users that they have today.
I understand. So should I keep the 5-year projections only to the Spanish-speaking market, or should I say?
I mean, for valuation purposes, that's probably the one.
The best one, yeah. Okay.
But you put yourself in our shoes. I mean, we don't want to be bullshitted, right? We want we want to see a plan that we kind of believe, that we can believe. I mean, we're a natural optimist. If you go into venture capital, you're an optimist. Otherwise, you shouldn't go there. But it needs to still somehow sound credible, that you have some sort of trust that the team can do that.
I understand. Thank you.
All right, we have a question in the chat. I don't know if I should do the voice track.
Yeah,
But
so we
basically,
have this instrument. So we have several of our portfolio companies, even from the core portfolio, when we invest in, more than we invest in Constructor start, like 500K and more. So we have convertible loan instruments. We prefer to invest in equity, but for sure, when you're in early stages, we can do also convertible loans or safes, depending on the situation.
We do that if we don't know the valuation sometimes.
Yeah.
That's if it's super early, we want to do something, we have no clue what the valuation should be, then we just cap it on the upside. So we do convertible with a cap, and then we see how the founder. It's safe as in reality, it's the same. It's differences. Convertible, typically you do one price for all investors versus safe. You can have different prices for different investors, but it's also convertible.
All right. I hope we answered. Yes. And Arash, yes, your turn.
Yeah. Hi, everyone. So I have a question, since our technology is like a software for quantum computers. So it's like part of the compiler stack of the quantum computers. And yeah, like we are somewhere in between like deep tech and software. So like, how do you consider our case as a venture capitalist? So do we have to have like the software like criteria as you were like describing, or more of a deep tech criteria?
I don't know, Marie, I would look at you more as a deep tech company. I would want to understand if it's a real because we all know quantum computers don't work yet. They're not scaling yet. You know, you're only selling pilots anyhow. The companies that you're selling to don't have a lot of revenue, so you won't have a lot of revenues. I would look at you more as a deep tech. Is this really a technology that is distinctive? I mean, we looked at a bunch of these kind of. Marie, what do you think?
Yeah, I agree that we are looking more at, even quantum software startups and products more from deep tech component, because actually to whom you will sell? You will sell to hardware players, as you will sell to quantum computers. And actually, this is your potential market, and this is your market. So yes, we will estimate more from deep tech point of view here.
Arash, I will buy your software once the company is running.
Okay, so you're building a computer, Adam? What kind of computer do you build?
So we're building a control system basically of quantum computer in a new generation of that, because currently each qubit controls individually, and we want to orchestrate that. So to send multiple signals in one medium basically, and then demultiplex that at the qubits. And we're still thinking if we start building qubits or not, or maybe later. But the controlling system will interact with the software at the top layer, basically. So we would need to interact with Qiskit or with a Magicware.
Yeah, cool. That sounds exciting. Yeah, we should look at that. Okay.
Yeah, also cool to have the collaborations between the startups for sure. So more questions, comments, concerns for now. I mean, we all can kind of get the interaction personalized, and if you have any questions, I think that Constructor Capital team can address some of the issues, but overall maybe something pops up.
Yeah, drop us an email, and at latest we see you on the 24th of February. And
exactly. Okay, we have more questions. So yes,
you have more
Martin.
questions. Okay.
Yeah, thanks again for the great talk. I had one question regarding the interaction between venture capital and CLAs, right? I mean, it's quite a common scenario that a startup joins an accelerator, you get an CLA for 100,000 or 200,000 or something. And then I heard that like afterwards, sometimes a bit of, sometimes it's not seen as, beneficial then for the investment, that somehow the accelerator somehow gets bought out or something. And I would like to know what your take is on this situation, because this is probably something you have already encountered.
Oh, I wouldn't care.
You wouldn't care.
If you get money from an accelerator, great. I think it's more a badge that you got. And you need some working capital, and it's good. And I couldn't care less. I mean, at the contrary, I think it's rather a sign of quality.
Perfect. I would also like upvote that answer. Thank you. Konstantin, we also have a question.
Yes. Thank you, Matthias, Marie, Aram. So I have a question about smart fundraising. So can you there's a proposed like algorithm, like step by step. How exactly it's better to do this smart fundraising? So where to find list of VCs which can fit my field, let's say health tech, med tech, and let's imagine I will get thousands of contacts, and how to make short list, I don't know, 100, which will be more but better fit my startup, and work with them more, let's say, more in more personalized style. What would you be like scenario how to work, to how to make fundraising smart?
Aram, you want to start?
I think we should define like what does it mean fundraise smart.
So I use your terminology. So don't waste our time and VC time for some connections which just doesn't fit each other in terms of money, in terms of
sorry.
topic.
In these terms, it's super simple. Yes, you should work only with funds who invest in actually in these areas. I mean, like investing in medical or like biotech. This is number one. And second one, you should focus to the companies who invest in at super early stage. And this is a focus actually, and this is a point because in reality, the number of venture capital funds who invest in at early stage companies, the number actually is much smaller than number of funds who invest in startups at later stages. In our words, it's only, I don't know, like 10, 20, 30 active funds who invest in like bio, in medical topics at super early stage, because again, it's super risky and not a lot of people actually who can evaluate this type of risk. I mean, like in our case, again.
Yeah, and on top of that, there's no, I mean, this is general networking, right? I mean, you start a company, you're in a certain geography, I don't know which country you're in, you start there, you show up at conferences, you present, you make connections, you ask for introductions. Even if a fund turns you down, you ask them, okay, are there any other funds that you could recommend that could maybe have a better fit? It's networking one-on-one. I mean, you start very small and then from there you expand. I mean, that's there's no formula. I mean, there are lists of venture firms, but I mean, truth is, if you just post, I'm interested in you on a website of a venture firm, chances that they will come back to you is not that high.
Yeah, so Matthias, exactly that's essence of my question, because so I am also in Switzerland, and so I do have some general connections, but they are semi-random. One colleague, another colleague, etc. And the question that maybe there is a resource which I don't know, which I miss, which can help me a lot. So probably there is no resource like this which I can Google and choose 100 out of 1,000. That's the question.
Probably not. No.
Not.
It's a job of networking, right?
Yes.
I mean, how do we find our investors in the fund? It's also networking, right? I mean, you start small and you get bigger and you build a small circle, and from there you go to a bigger circle and a bigger circle. So I should also try not to burn too much money too fast, because it takes time to do this networking.
Yeah. Okay, thanks. Thank you.
All right. Well, with this being said, if there are no more questions, then first of all, I am announcing again the feedback form for the founders. So please go ahead and evaluate the session that we just had. And moreover, again, reminding you of if you have like catching up the opportunity with any questions with Constructor Capital, then you can go through us directly. You can go through your mentors. I mean, you have some of you have Valentino and Marie, so part of Constructor Capital team, and also latest, yes, exactly on demo day, where the team will be via in the audience and on the stage, both sides. Let's put it like that. Okay, well, there are already some advice. So Ivan, thank you so much for the comment on the databases, I guess, of the investors. With this being said, I'm thanking our dear speakers, Matthias, Marie, and Aram. Thank you so much for providing your insights. As always, it was very up to the point and up to the strategy and tips and tricks, let's put it like that. So your point of view, I think there is no better words than you have just said on choosing smartly, going when you need to fundraise, not just for the sake of the fundraising, and overall just gaining the momentum as well. So yeah, in case anyone has any comments to go, this is the last chance, or we're just wrapping it all up and going ahead with a productive evening. Okay, well, I guess everything went really well. Claudio, I see you unmuted, or you just want to say thank you.
I just want to say thank you. Very informative sessions. Yeah.
Yeah, you were in the train, so that's why it's okay for you to. Thank you so much for turning on the camera. Actually,
yes.
All right, then with this being said, let's wrap it all up. Wish you a very productive evening, and tomorrow we will have interesting new format, peer-to-peer exchange with Sprit. So batch 2 participant who got the fundraising successful this year, and we will get to know the freshest tips and tricks from the founders' perspective already. Thank you a lot. Thank you, dear speakers. Thank you, the founders. And see you around. Have a nice evening ahead.
Thank you, guys.
Good